Earnings day for Burger King. Today, shareholders are going to hope to see some nice, juicy returns, especially after trying to land a whopper of a deal in May 2006 when the restaurant chain released its initial public offering, an IPO. IPOs can be tempting, but how do you know whether yours is going to be a good one? Would you rather be rolling in cash if you got in on Burger King last year? Brian Hamilton is the chief executive of SageWorks, which translates complex financial data into lay terms for the average investor. Thank God. And he joins us now to talk about IPOs. IPOs are a little bit of a difficult concept for people to get their hands around. If an average investor is looking to get involved with an IPO, what should they be watching for? Okay,
really simple, and keep it simple. There are four basic things that any IPO, or any company for that matter, should really be evaluated on. Are sales growing? Is the company profitable? Does it have positive cash flow from from operations? And is the balance sheet pretty tight, or is it upside down? If the company's got those four things, Peter, then we can go further and look at valuation in the sector and that type of stuff.
Now, where do you get that information from?
Well, the filings. That's the beauty of it. You can go to edgar.gov and you can just look up the financial statements and read them. And it's all straightforward. And sometimes people get so caught in the buzz, Peter, that they're caught in the excitement of the IPO. Will it be the next Microsoft? That they don't even look at the financial statements. So look at the basics.
So the positives that come with IPOs are, hey, might be the next Google.
Right. And often that's not the case, obviously.
Yeah. What's the record for IPOs typically?
Well, this year they're up, and they tend to track real well with the overall stock market. But I will tell you that there's a lot of inventory on the market right now that is a little bit weak. The companies are going out a little bit too early, I think. The revenue's not there. Or if the revenue's there, they're bringing in money in the front door real fast, but it's going out the back door faster in terms of losses.
Yeah, and so one of the pitfalls might be this and supply and demand. If there are a lot of IPOs coming out at the same time, the stock, everybody thinks that the stock is just going to pop as soon as there's an IPO. That's not necessarily the case.
Absolutely not. In fact, you've got a lot of venture firms and a lot of private equity firms, as you know, they're trying to get liquidity through an IPO. So there's just a bunch of inventory out there, so you got to be careful.
Now, and I know that when I tried to get on IPOs when I was really young and stupid as an investor.
I remember.
Yeah, we all do remember that. One of the things that was a challenge is that the companies that got the brokers that got the allocation, like a Merrill Lynch or a Smith Barney, required you to open up an account and actually put a substantial amount. For me, you had to put a substantial amount of money, tens of thousands of dollars in an account in order to get access to an IPO. What about that?
That's a little bit dated now. You've got internet facilities. The mechanics are pretty simple. E-Trade, Ameritrade, something like that. So that's not an obstacle any longer in my mind.
What about some of the financial gimmickry that goes on? I know with the Burger King deal, there was a challenge because the owners, the original investors, gave themselves a huge hundreds of millions of dollars in dividends back before the IPO, which meant that the company didn't have enough cash to actually perhaps operate properly.
True, and there's a great company, special orders will not upset us or whatever the old lingo is. But a good company, but before the IPO, they took on a lot of debt, and I wasn't too happy about that, actually.
Right. So, and you can find this information again in the filings with the Securities and Exchange Commission.
Read the footnotes. There's a lot of goodies in there. There's a lot of good information in there about what the company's doing. It's usually plain language. People don't realize that.
Now, looking back, what was the one IPO you wish you had gotten into?
Well, I have to say Google.
Google, yeah.
Everyone
says
Google, yeah. But Google, Microsoft, those are, obviously good IPOs. They've done great.
What are some IPOs that have not done as well recently?
Well, the big one to me is Clearwire, Limelight. Athena's done well in the initial offering. But those companies are really interesting. They take on a profile. The revenue's coming in, it's increasing, but their losses are going faster than the revenue. So they haven't done that well, especially Clearwire. They're just losing tons of money.
One of my old sayings, bromides that I live by in this area is that got to be careful when the smart money is getting out, if you will. And a lot of times when you see an IPO, very smart people are selling. Isn't that a red flag?
Let's turn that upside down too, though. Look at the financials yourself. Look at basic common sense thing, like if you're running a lemonade stand, is the revenue going up? Is the company profitable? Sometimes even the pros miss those basic things. So, you don't want to go with the crowd. You don't want to go against the crowd. You want to be independent. And even people who don't know finance can do that.
All right. Thanks very much, Brian, for coming in. When we come back, we'll head over to London for